The US stock market and the economy in general are headed for a crash. And this is coming in the not so distant future. In this video, we're going to show you the evidence and the implications. Now, the stock market has had quite a run since its low in 2009, and mainstream pundits are quite happy to keep selling you the illusion that this trend is going to continue indefinitely. But the reality of the matter is that it cannot continue, at least not for very much longer. What we're witnessing is a bubble that has been inflated through the Federal Reserve's quantitative easing policy and market sentiment, not fundamentals. So what are we talking about here? What is quantitative easing, and what does it have to do with the stock market? The Federal Reserve has engaged in 3 rounds of money printing, or quantitative easing as they like to call it, since the crash of 2008. QE1, QE2, and now QE3. Unlike QE1 and QE2, QE3, which has been underway since 2012, doesn't have a time limit. It'll keep running until the Fed decides to end it, and no one is willing to say exactly when that's going to be. During QE3, the Federal Reserve has purchased $85 billion in mortgage-backed securities and treasuries each month. These mortgage-backed securities are comprised of home mortgages bundled up and resold as investments. These are also the same toxic assets that set off the 2008 crash. It sounds really technical, and most people's eyes will glaze over when they hear stuff like this. But what it comes down to in simple terms is that the Federal Reserve is bailing out the banks by propping up the price of these bad investments. We couldn't have the banks paying the consequences for their own mistakes, now could we? The official motive for this policy is to prop up the economy so that it can recover. But in practice, this is just welfare for the super rich. The evidence for this is easy to find. The number of U.S. residents living in poverty has risen since 2012. It's now up to 46.5 million people, according to Reuters. This while the stock market has been booming. Why? Because QE3 has led to record profits for the banks. And banks don't let extra money sit quietly in accounts. They invest it into the stock market. And as money flows into the stock market, prices rise. Whoever owns the most stocks benefits the most from this increase. And who owns the most stocks? Well, that would be the wealthiest segment of the population. Stock prices have climbed steadily since 2009, reaching new highs in recent months. As usual, rising prices fed investor enthusiasm and people started believing that the party would never end. It's a recovery! America is making a comeback. Just one problem. This party is running on $85 billion of funding money that's being injected into the system every month. Sooner or later, the Fed is going to have to pull back. No one is denying this, not even the Fed. Most market analysts believed that in September of 2013, QE3 would be slightly reduced or tapered off. And as a result, there was a sell-off leading up to the announcement. However, the Fed decided not to slow down the printing presses at all. QE3 would continue. Markets rallied quickly after the announcement, but then they stalled. This is without the Fed actually making any changes. So clearly, investor sentiment is playing a huge role here, and that sentiment is vulnerable. Now, there's no way to predict the future with 100% certainty, but there are a number of indicators that point towards a massive downturn in the market at the end of 2013 or early 2014. One of the first warning signs has been the exit of insiders from the market. The Sentiment Trader's Smart Money, Dumb Money Confidence Index tracks what insiders are doing versus what the average investors are doing, and this index shows a sharp divergence developing between the two. Of course, insiders aren't going to advertise this kind of thing because they want to get their money out before the mad rush to the bottom starts. Why would the smart money be pulling out of the stock market? Well, because they understand that markets run in cycles, and bubbles always pop eventually. According to Ned Davis research, there were 33 bull markets from the beginning of 1900 until March 2009. The average length was 2.1 years. Only 5 of those 33 bull markets lasted longer than that. The current bull market, which began in 2009, is almost 4.5 years old. If this market was natural, it would have had a correction some time ago. But remember, this market is not natural. It's being propped up with $85 billion of funding money per month. Now, of course, there are a lot of people who are emotionally and financially invested in this market who will point to the fact that by most indicators, it's still strong. However, if you look at charts for previous bull markets leading up to crashes, you'll see that this is to be expected. Markets always look best right before they fall. This chart shows the stock market leading up to the 1987 crash. This chart shows the stock market leading up to the collapse of the dot-com bubble in 2000. This chart shows the stock market leading up to the collapse of the housing bubble in 2007. And this is a chart of the stock market from March 2009 to present. To make this a bit clearer, let's look at the 2003-2007 chart alongside the 2009-2013 chart. According to Carter Braxton Worth, chief market technician at Oppenheimer Asset Management, the correlation between these two charts is 95.5%. Another metric to look at when assessing the likelihood of a market crash is the Shiller price-to-earnings ratio. Price-to-earnings ratio is the ratio between the price investors are paying for stock and the actual earnings for the companies in question. When you see the price-to-earnings ratio rise, this means that there's a growing disconnect between the stock price and the actual earnings. There are a number of variations of price-to-earnings calculations, but the Shiller calculation has consistently shown the same thing as markets are getting ready to crash. The stock price goes up dramatically without a corresponding rise in earnings. If we look at the Shiller price-to-earnings ratio, we see that it's been rising dramatically since 2009. And right now, it's about to hit a resistance line where a correction usually occurs. Does that mean that a correction is guaranteed to happen right away? No. One thing that's really important to understand here is that markets aren't just driven by numbers. Sentiment plays an enormous role. The numbers point towards underlying vulnerabilities that are exposed when the market sentiment changes. Since 2009, the Fed has been inflating a bubble of epic proportions. That bubble is going to pop. It's just a question of what will trigger the crash. The Federal Reserve is in a bit of a corner here. They understand that if they cut back on QE3 in any significant way, the bubble will burst. Bernanke knows this, and that's why he's stepping down. He doesn't want to be in office when the consequences of his policies come home to roost. They want to delay this as long as possible because if it bursts right after a change that they make, they'll obviously get saddled with the blame. However, even if they don't pull back on QE3, any major crisis that hits in the coming months will wreak havoc on market sentiment. And this would trigger a correction. In such a scenario, the official line will pin the blame on the event that sets the downturn in motion, rather than on the bubble itself. We saw this after 9/11, which knocked the last bit of wind out of the dot-com bubble, even though that bubble was already unwinding. This was convenient because almost no one put any attention on who created the bubble in the first place. Regardless of what triggers a correction, whether it's an external event or a pullback from QE3, and regardless of whether this happens in the next few weeks or months, the crash is coming. The Fed will of course attempt to intervene. However, they really only have two tools at their disposal: the ability to lower interest rates and the ability to create new money. Interest rates can't really be lowered anymore, and the Fed is already pumping $85 billion into the economy every month. Will it really have a significant impact if they double down and launch QE4, injecting say $170 billion each month? In the context of a mass sell-off, that's doubtful. There's a law of diminishing returns when it comes to printing money, even if you do control the petrodollar and the world reserve currency status. It's like a drug addict whose tolerance has been increasing even as their body is reaching the breaking point. To influence the outcome this time, the Fed will have to go for broke. And this could easily lead to an overdose. The real black swan here is how the international community reacts to Fed policies. We already see the Bank of International Settlements calling for an end to the Fed's money printing, and there are signs of a currency war brewing. Throw a literal physical war into the mix and you've got yourself a really dangerous cocktail. If instead of ending QE3, the Fed adds to it, as they would in the event of a crash, then we're opening up Pandora's box, and at that point, all bets are off. For more videos like this, subscribe to Storm Clouds Gathering on YouTube. For updates, bonus content, and to influence future videos, follow us on Facebook at facebook.com/stormcloudsgathering. Our Twitter handle is Collapse Updates, and our website is stormcloudsgathering.com.